Good morning, folks. Greg Silverman, CIOs and bow ties, trying to get acclimated to what the time is and what the day is, given our current situation. It's 9:15 a.m. It is the 31st of March, and we've got a return guest here. We've got Adam Cohen from JJ Cohen, a turnaround and restructuring expert. And Adam, I'll go through your bio again, probably a little bit later, because we already have done that the first time round. And, what a difference 3 weeks makes, let's say. I think our first edition of podcast went out around March 2nd. So it's now the 31st. And boy, oh boy, this world has turned dramatically in that space of time. So we're going to talk about what Adam is seeing, the changes and opportunities that have presented themselves, specifically turnaround, distressed, restructuring, etc. So let's not pull the cart before the horse. Adam, welcome back to CIOs and bow ties.
Thanks for having me.
All right, let's talk about this. A lot of us have got whiplash from the markets having turned around so quickly and become so volatile. So what a difference 3 weeks makes, huh?
Yeah, absolutely. I know last time we spoke, you asked me what advice I would have for distressed investors, and I said wait. I didn't know what we were waiting for and would have never predicted, even a month ago, even as we were watching China and other countries go through their COVID-19 issues. It's amazing in retrospect how so many of us missed this. It's unfortunate to me seeing so many companies that I've worked with that maybe had issues in the past. Maybe we're still struggling a little bit. Some were actually on the right track and doing well, but they may not have had the balance sheet to weather a big storm like this. And, in speaking with a handful of companies, some that are new, some that as I mentioned, I've had a fairly long relationship with, a lot of them are feeling somewhat out of options right now. And, they're going through the somewhat confusing stimulus package, trying to figure out how or if it applies to them, and really just figuring out where they can go and how they can ride this out for however deep it gets or for however long it goes, which again is still very unknown.
Right. I know, personal financial advisors, they speak to individuals and they say, or families, and they say, look, you probably need about 6 to 12 months reserve cash or readily available cash. What's the comparison with small and medium enterprises as far as kind of an emergency fund is concerned?
I think that's an interesting point, and that's what I've seen for a long time. It's like in your personal life, you plan for the possibility to go to zero, and it makes sense because most Americans get 100% of their income from a single source. And so they're always planning on that source to go away. You look at restaurants and retailers, and name the company, but they're much more diversified. You've got, hundreds, sometimes thousands of customers coming in every day and giving you a little bit of money. And so the thought is, okay, so maybe we go down 5% or maybe we go down 10%, but we're not going down 50. We're not going down 100. And that's exactly what's happening to so many businesses right now. I think you posted a chart on LinkedIn that I love, and it goes through the number of days of cash that companies have on hand. And I think the number was somewhere slightly less than 30 days. So less than a month of cash on hand. Right.
Let me interrupt your train of thought one more time, just for the listeners. There will be a link below this podcast that posts to the particular chart that Adam is talking about. And if you're watching this on the screen share version, which would be on YouTube, that is up in front of you. So please continue, Adam.
No, thanks. And if you'll see on the chart there, it's subdivides by industry. And what I found was interesting was that retail and restaurants were two of the industries with the lowest number of days of cash on hand. And then you think about it, and those are two of the industries that are the hardest hit right now with, some casual dining, restaurants down 50, 60, 70%. Even in more of the fast food range, you're talking about double-digit declines. And then, of course, non-essential retailers in many cases are just absolutely shut down right now on ice.
Okay, that said, I believe from our chat a little earlier, there are some companies which are actually not faring too badly through all this, and maybe touch on those a little bit.
Yeah, no. The one that comes to mind is a food manufacturer that I've done some work with, and typically very low margins, very highly competitive. The number of SKUs on a shelf in a grocery store has just grown exponentially over the decades, which just further dilutes what a brand can do, reduces barriers to entry, all the things that make, put pressure on profitability. But right now, everyone's stuck at home. Everyone's worried. There's panic buying on essentials, and people don't really care what they're paying. They'll pay for delivery. They go to the grocery store and they empty the shelves. And what these guys are seeing is that the reorders are up and the promotions are down. Grocery stores realize that they have an extremely captive audience right now. And, maybe they're not raising prices to alert anybody of price gouging. But what you'll definitely see is that the promotions, the buy one, get one, the $1 off, $2 off, instant savings, they're reducing significantly. And that's helping grocery stores, and that's helping the food manufacturers that are actually subsidizing most of those discounts most of the time.
Right. You speak about price gouging. I noticed an article, I think it was yesterday, of all places, a guy in Georgia got arrested by the FBI for price gouging. And so, don't think for a second that the FBI are not out and about and watching how people are, or companies or individuals are behaving during this time. So I think, we all need to just defer to our best ethical behavior. Otherwise, you will certainly end up in some kind of hot water.
Absolutely.
Okay, $1 million question here, and I know that you don't have a crystal ball, and I know that you're also operating in real time, but give us a synopsis of, based on what you're seeing on the ground, kind of the next 2 to 3 week type outlook.
Well, I don't know if it's $1 million question or $1 trillion question. I'll
$2 trillion.
Start out by saying that if I thought I had a good answer, or if I had known, I'd probably be making a lot more money in the stock market now than I am currently. That said, I think that all companies that are struggling at least should realize that they're part of the majority right now. And that can be very helpful in a situation like this. So what I mean is everyone is struggling with reduced revenue. Everyone's probably getting hit with slower collections on top of lower revenue, which can have a compounding effect, by the way. But what that also means is that they're not able to pay bills. And there's a very easy story to tell to their lenders, to their vendors, to their landlords, and any other creditor that may take action against them. They've got a story to tell. It's not, hey, I'm the only business that's having trouble and you should stop working with me. You know, let's talk about the landlords, for example. The food establishments and the retailers almost unanimously have been talking about not paying April rent, which is due tomorrow. And I've heard stories of landlords actually reaching out to their tenants and saying, we want to work with you and we understand that you may be late. We want to talk about what that means. And we're just want to let you know that we're not looking to take action. We're not trying to evict you, and we're not going to be, you know, really hard to deal with. We are going to get through this together. And we all, you know, look, let's not kid ourselves and think that it's just really philanthropic landlords. They realize they don't have other options either. If you were the only business struggling, they would want to get you out of there as soon as possible so that they can get somebody else in. But right now, you can't evict everybody. That's not going to do the landlords any good to take somebody who's not paying rent, who may be paying rent 4 to 6 weeks from now, and put in somebody else. And so that, you know, I think that and the ability to put a lot of these businesses basically on ice for a little bit and reassess where we are in 4 weeks from now or 6 weeks from now or however long it takes, reassess then and figure out where we are without the threat of, you know, being forced into bankruptcy or being forced out of business due to slow or non-payment.
Let me follow that on with one other question. And I've read about this more in the case of individuals, but I suppose it can be extrapolated to companies as well. So let's say you have a situation, an individual who's now trying to get hold of their creditor, let's say their landlord, and the landlord's not picking up the phone. Landlord's kind of gone a bit AWOL, maybe, you know, for whatever reason. And then, you know, the dust clears and we're talking about 3 months down the line, and the landlord said, well, listen, you never tried to contact me to renegotiate. You're late on your rent. There's a lot of fees. And by the way, I'm going to report you to, you know, to the credit bureaus as well. And you really have no, you know, what's your recourse at that point? And so again, that's an individual problem, but I suspect something similar can be happening with some, you know, pretty hard-nosed landlords in the corporate sector. What's your suggestion there? How do you deal with that?
Yeah, I think it sort of depends on where your business is. We've had those concerns come up in the past, and absent formal bankruptcy protection, a lot of times leases, you know, read where landlords can move fairly quickly. You know, especially in, you know, maybe more business-friendly states, free market states, call it. They can take action fairly quickly. And so there always is the concern that you're in a location that is very desirable. You're in a really long-term lease with fairly below market rent. And the landlord has been just waiting for you to trip so that they can kick you out or renegotiate the rent to something much higher, find somebody else who will pay more. And I think there still is the concern that right now, you know, for those leases, somebody trips up, somebody can't make a payment, and the landlord comes back and says, you know what? Here's a case where I would rather kick the person out, let it go vacant. And I'm confident when this thing sorts itself out, I can find somebody to pay twice as much rent on the same amount of space. And maybe it'll even be the same tenant, but we'll do it with a new lease. And And I think it's more of a legal question that I would want, a lawyer reviewing that specific lease and giving advice to that company. And it really depends on how, financially strapped that company is and what the lease says and what the default language is and what the remedies for the landlord are. But it really becomes a case-by-case judgment call. And sometimes, especially for multi-unit operators, it becomes a bit of a triage. And I've seen it a lot of times where you say, all right, these are the 5 leases out of 50 that I just don't want to mess with. They're too good of deals. The language is too tough on, non-payment or other default. And, I'll slow pay or I'll defer all of the other ones. But my best option is really just to pay if I can.
Okay. Well, at the very least, the logical answer on my side would be if you're a tenant, you certainly just want to send a registered letter, certified letter or email. We have some audit trail that you try to reach out. Let's switch the conversation because, everything revolves around the macro at this time. And certainly part of that macro is government stimulus and all of its intended and unintended consequences. But let's just talk about that for a real sec. How is all the stimulus dollars going to get down to your area of the market, the SME area? Talk a little bit about what your clients are saying about their reliance on this cash being delivered to them, in a fairly quick manner.
Yeah, I think, first of all, I think in a week from now, we're all going to know a little bit more. I've done some reading up, and my clients have been reading up on the government package, but being that it's so new and so long and so confusing, I think we're all sort of learning more and more every day. Obviously, there at the very lowest level, at the consumer individual level, there are the $1,200 per person stimulus checks, and and everyone's hopeful that those will start coming out in the next couple of weeks, and that'll provide some cash for people to spend more money. And spending more money is typically good for my clients. You go to the next level up and you look at small businesses, and I've seen a lot of things going on with SBA loans, with, enhanced unemployment, and basically not only are the unemployment benefits better that where the actual companies are not having to go and worry about or feel guilty about severance or things like that. The government is coming in and helping with that. But the government is also helping with paid time off. And what I've seen is that they're offering for entities with fewer than 500 employees, if somebody has to take time off to care for somebody who's sick with COVID-19, they're offering up to 80 hours paid at a 2/3 rate to cover that. And that's government paid. So the company doesn't have to worry about encouraging somebody to come to work who may have those other obligations. And then for somebody who actually is sick or thinks they may be at risk of being sick, they're actually offering another 80 hours at full pay. So again, you're running a restaurant and there's, somebody who's got a fever. You're not wondering, well, maybe I should keep them because I can't send them home unpaid and I can't afford to pay them. You now have that backstop. And so there are things that are coming in that are good.
Sorry, just jumping in there. How do they get that money? How do they get paid? Is it through your local state Department of Labor, through unemployment benefits, or is that just not even clear right now?
Yeah, no, I believe it is. Honestly, I'm not the expert on the execution of that, but I believe it is. They're actually putting up new Department of Labor posters and things like that go over, the mechanics of that. And I'm seeing the emails go out of all the new required regulatory documents that have to be placed in every break room around America.
And not how many break rooms have you been in around America in the last few weeks? But anyway, neither here nor there. The question on everyone's mind is obviously how long that actually takes, for this lifeblood to arrive. Perhaps more on the SBA side, I suspect you've probably been involved there a little bit with clients. What's the expectation of how long, some kind of funding can arrive from the SBA to an SME, small, medium-sized enterprise?
Yeah, well, I think that's exactly the problem. I mean, we spoke about it earlier, and said we've got companies that are measuring their cash supply in days, not weeks, not months, not years, and then the stimulus package says go apply for a loan with the SBA. I mean, I had a client probably a week and a half ago trying to actually apply for a loan with SBA, like the day that it came out, the day that they mentioned that this was coming out. And, they're on the Georgia SBA website, and literally it was like the button that they had to click looked like it was I've been in a tornado or a hurricane type of checkbox. And it was like scratched out to include COVID-19. And the person who was filling it out had to go through multiple tries. She kept getting kicked out because of the high volume on the website. Every time she went back, there were multiple changes to the form because honestly, you've got the people in Congress dreaming up the next idea to put in the stimulus package, and then you have everybody on the ground trying to execute,
trying to implement,
and that's what really everyone's wondering. It's really how long can we survive? And if I've got to not pay any bills for 2 to 3 weeks, sure, I can manage. But if SBA is going to then get inundated with applications, which you're sure they are at this point, what do 2 to 3 months look like? What do 4 to 5 months look like? And when can the money actually get into the small and medium businesses' pockets so that they can now get caught up on rent or get caught up on, pay other payables?
Right. You mentioned somewhere along our conversations, it might have been in the last series, no, I think it was subsequent to that, about some businesses that actually potentially can fall through the cracks. In essence, they're not big enough to receive direct stimulus. They're not small enough to get an SBA loan. Maybe a bit too mid-size, if you will. Hey, what's the story there? What do you make of that?
Yeah. I mean, those are, I think I mentioned less than 500 employees.
Yeah.
You get the extra, unemployment benefits. But then you go above that and you get above the SBA thresholds, and you're right. The options seem to decrease until you get into the multi-billion-dollar size and you get into the too big to fail. So, Delta and United are going to get taken care of, and they probably don't have to fill out the same application that, small businesses do. And then you've got everybody in the middle. And furthermore, I believe a lot of these stipulate that when they are doing these tests on size, affiliated businesses are included. And that doesn't mean, falls within the same LLC. But if there is a common management team or a common ownership structure, it counts. And so a lot of the news is that basically every business that's private equity owned would then fall under affiliated businesses, and you're taking, a lot of $10 and $20 million businesses and aggregating them and saying, okay, well, we're treating you like you're a $1 billion business because your PE sponsor owns all of these other companies. And then what it's basically saying is it's up to the PE company and its investors and its lenders to fill in the gaps. And the question there is, how much dry powder do they have? Is their committed capital going to come through? And what triage are the PE firms doing on their own portfolios to say, all right, if I only have enough additional capital to prop up half of my businesses, which half am I going to invest in? And, which ones do I allow to die to, as a sacrifice for the greater good?
Yeah, unintended consequences, no doubt. Certainly I'm going to put words in your mouth, but I imagine if your clients have lines of credit or other facilities open to them, you may be recommending that they draw down on those just for reserve purposes. What other advice would you offer to corporations, small businesses, medium-sized businesses that are facing difficulties? And frankly, I think we're all facing difficulties at this point.
Yeah, no, I think the biggest piece of advice is to really ensure that you understand and have modeled out all of the scenarios. And this is one of those times when I've met with clients, over the years, and you say, all right, what does the downside scenario look like? And it always ends up with this like -3% top line growth as the downside. And you go, okay, but what's the real downside? They're like, okay, well, -4.5.
-5.
Okay. Right. Okay. Twist my arm. This is the time to really go deep. And I had one client who I think really got it. And they said 2 weeks ago, they said, we want to model -75% on top line. And we want to do that for, a few months. And on top of that, we want to model in slower collections because my collections are from 30 days ago. Those should still stay strong. But what if I'm not actually collecting that money because none of my customers can afford to pay me now? And, you look at that and you say, great, well then what do I need to do differently? Well, you can't pay all of your bills. And then you start having those conversations of what does that actually look like? And you start actually prioritizing your bills. I think if you were to put your goals in order, your priorities in order, you would say, all right, number one is business survival. And to do that, I've got to handle critical payroll. I've got to handle then critical vendors and then everything else. And when you say critical payroll, that may not mean everybody on payroll is critical. And part of achieving business survival is paying the people that you absolutely need. And, maybe it means furloughing or letting go of the people that you don't absolutely need right now. And it ensures that the most people are, keep their jobs going forward. And, I think what we've learned in the last few weeks is that this isn't going to go away as fast as we think. Government's already extended a lot of these stay-at-home recommendations through April. The case counts continue to grow. The death count continues to grow. And, everyone should really think about what they need to do.
Well, certainly, I think, I'll give the mic back to you in a sec. Adam, I know you're judicious and you don't say this, I'll say it on your behalf, but I know a lot of what you do with clients is this kind of forecasting and modeling and coming up with a plan and seeing if you're following the best case, base case, worst case kind of thing. So just for listeners to know out there, that is essentially a bit of your bread and butter. just want to change the conversation to one area, merely because I think you have the knowledge and it's a bit beyond me, and it's really out of the scope of the small and medium enterprises. But, you know, if you've got greater than 500 employees, you get a bit of a payroll tax, what should we call, relaxation. In other words, what you would deduct from those 500 or greater employees for payroll taxes, those corporations can now essentially use that cash, I guess, to buttress anything else they want to, instead of paying it over to the IRS. It sounds like a bit of a strange mechanism to me. Do you have any thoughts on that? I would have thought, don't take the payroll tax out of the check at all and let that flow down to the employee. It just struck me as an odd mechanism. What do you think of it?
No, I mean, I think it's another just really quick way to get more money out, and it's a way to impact basically almost every business instantaneously and somewhat pro rata. So the bigger companies are going to get bigger benefit, smaller companies get smaller benefit, but percentage-wise, everyone works out. And it doesn't require a new application. It doesn't require, you know, any other approvals. It's just you can literally see it by this Thursday.
Got it. Okay. Any other advice for businesses facing difficulty? I kind of took the conversation on another track.
No, I think really it's just if you have a model, you should really stress test it, and from there you develop your plan. If you don't have a model, if you're not tracking your cash weekly, if you're not tracking your cash daily, if you're not tracking your 5 top metrics daily, make sure you're doing it, because things change often. We're seeing it now, and every day we're learning a little bit more. What we don't have is the luxury, or most businesses don't have the luxury right now, to get to the end of the month, have the normal 2 to 3 week accounting close period, and sit down on April 21st and figure out what happened in March, and then make changes from there. By that point, we're going to have a lot of dead businesses. So that's typically where I start when I go into a project. It's building a cash forecast, it's stress testing it, it's building usually call it 3 to 10 top metrics that we can very quickly monitor on a daily basis, and getting that done in a matter of days so that we can start really understanding where we are and really planning on where we're going to go.
And where we're going to go, the execution, I assume, is very it's very heavily involved with communication with both your creditors, we used to call them debtors in South Africa, I guess accounts receivable, and all other interested stakeholders. Would you agree with that?
Yeah, absolutely. I mean, and the plan is different depending on which department you're in. I mean, the one client I was working on last week, in a matter of days, we ended up with a new cash forecast with multiple scenarios and toggles. We ended up with a collections tracker for multiple entities that they had worldwide, so that we can then, go after all of their customers that may be slow paying. We were able to change the focus where the collections process was very focused on customers that were more than 30 days past due, to where we said, you know what, right now it's great to go and get that money, but that's $1 million of our, call it $30 million of receivables. And what we're more concerned with right now are all of the customers that used to be paying in 30 days or 35 days, 0 to 5 days past due, moving to 5 to 10 days past due, and then 10 to 15 days past due. And if everybody skips a week, we just lost, $5 million. And we don't have $5 million to lose right now. And so that requires a different skill set, a different sense of urgency, a different cadence on tracking the collections and the collections process than it used to. We no longer have the luxury of waiting till someone's 30 days past due to send them an email. We've got to wait, we've got to send an email or get on the phone or start talking about, cutting somebody off who didn't pay on Wednesday that where the bill was due and their practice was to pay on Monday. And really understand what's going on and really make a plan from there. Okay.
Let's take a different approach here for the next question. Let me lay it up as follows. So, we've spoken about this a lot around the tremendous issuance of private credit, illiquid private credit. And it's not only credit instruments, it's a lot of instruments that are predicated on accounts receivable, factoring, and other kind of yield-orientated strategies. And just, my thought is, given that rates are so incredibly low, at some point these strategies will make some kind of a comeback. But right now, I think the opposite is in play, and I think a lot of people are going to realize there was more risk involved in this private credit than there was prior. Certainly on the accounts receivable side, we've spoken about that. If you have a note which is a factor of an accounts receivable, slow pay of the accounts receivable is equal to slow pay of the note that you hold. So that's my way of kind of laying up this segment of the interview, Adam, where, what should investors, such as myself and many of the allocators who are listening to this, how should we think about this timing, existing portfolios, etc.?
Yeah, I mean, if you're in it, it's trying to figure out a way to
call you,
get back to call me. It's trying to figure out a way to get back to safety. And obviously, I'm sure there are a lot of people who aren't very comfortable with the situation that they're in. And, it's people who are invested in stocks. It's people who are invested in bonds. It's people who are invested in good bonds, bad bonds, and as you mentioned, all of the private credit. I think, my opinion to not do is just knee jerk and start immediately pulling back across the board, because as we've discussed, it's one of those things where you can go to zero fairly quickly. And just like the PE firms are playing triage with their companies, private lenders have to play triage with their companies. What a lot of those guys didn't realize is that they were basically making a slightly safer equity investment in a lot of these companies. And at this point, they've got to act as such. If the answer is we're not putting any more money into anything, they might see a lot of their investments go to zero. But the ones that have promise, the ones that are just dealing with a blip, and the ones that just need a little bit of room to get through this, I think investors are going to have to flex on their current portfolio.
Yeah. Okay. So I think that element of control is somewhat lost when you're an investor versus the operator. How about prospectively looking forward? What any advice you would offer someone who's been waiting patiently, as we have, to deploy into distressed situations? Any advice? Any top of mind things that you could tell us?
Yeah, I mean, I think I think if I had the crystal ball here again, I'd probably be doing something else. And we're all trying to remember that chapter of epidemiology we read, back in high school, and try to figure out what all this means. The truth is, I think the only thing we've gotten is about 7 billion new opinions over the last, 2 to 3 weeks. And a few of them are going to be right, but a lot of them are going to be wrong. So given all of our uncertainty, it's hard to say there's definitely a clear strategy. I think if you're looking for prospects, feel good that the opportunities just got better than they were a month ago, and be glad that you're sitting with your dry powder today and didn't put it to use in January or February. So that said, there's still the falling knife that we may have going on, and trying to catch that. And I think what most financial advisors would say is it's okay to invest in as long as you don't go all in. You know, have some extra money on the side to add on to your position. So if you're buying when the Dow's at 20,000, keep a little in case it drops down to 18,000. And keep a little extra if it goes to 16,000. And if it goes back up, it goes back up. Like if it just turns out that 20 was the bottom, then you didn't get all in. But the same thing here, and furthermore, it's not just being able to dollar cost average, but it's recognizing that you might put $5 million into a business that you love, that you think just needs that support to get through the next 2 months. But what if it turns out to be 4 months and they need another $3 million? Make sure that you're able to do it, so that if you still believe in the business, you still believe in the model, but the situation was just a little deeper, a little more dire than you predicted from a macroeconomic standpoint, that you're able to weather that and you don't end up just throwing good money at that.
Yeah. How about industries? Where should we be looking from an industry perspective, or is it, well, or it's probably a double, the answer is probably both, but, you know, is it better to engage with the specialists such as you, focused on, you know, certain verticals, or is this just a broad-based distress cycle where it's better just to put your chips, you know, in many different opportunities?
Yeah, I don't know the answer to that. I think, you know, there's the one school of thought that says, all right, well, look at where we were before this happened. Look at which industries had the most promise and invest into them. We did see that retail was overbuilt. The shift to, you know, online shopping was really straining brick and mortar. And so then you say, well, we know retail is struggling now, but do I really want to invest in it? Because if things get better, they're still going to face the same problems they had before. You look at food and look at the overdevelopment that was done there. And that's not to say that the food industry is declining, but just it's not growing as fast as the supply is growing. And so you end up with 72 options in a 2-block radius, and you say, well, maybe I really only needed 30 or 40. And do I really want to invest in that kind of model that is really struggling right now and will probably still be somewhat struggling even if all of this goes away? Now, that said, I think a lot of that is already factored into prices right now. And so just like you can buy Delta stock for 50 to 65% off of its 52-week high right now, some of the industries that you would normally say, ooh, I definitely want to stay away from, maybe, you know, maybe that's the blood in the water, blood on the streets that you actually want to invest into. So look, maybe I should have just kept it short and said, I really don't know.
I don't know. No, I appreciate it. I guess one should invest where their aptitude takes them. It's probably, and their emotions don't, is probably the wise choice. I think we pretty much covered, most of what I wanted to touch on. Let me hand it back to you. Perhaps you can just summarize for us one more time. If you have a case study top of mind about, again, some of the, what's the top three things people should be, or companies should be looking at right now? Maybe one top thing that an investor should be doing right now, kind of as far as circling the wagons are concerned, in anticipation of making an investment.
Yeah, no, I think, from an operator's side, I think it's tracking revenue very, very carefully. I think it is tracking collections just as closely and knowing the difference between the two. And then using those pieces of data to determine how you're going to disperse your cash and communicating with vendors and lenders and other creditors appropriately. From the investor side, I think it's the same thing, but it's understanding that model and understanding truly what is it going to take to prop this company up and make sure that they can weather the storm. And underwriting, do I as the investor have the capability to create that bridge? And am I getting paid adequately for the amount of risk that I'm taking?
Right. In your estimation, are we too far in the process now that going back to whatever it is now just simply out of the question? Reversing the clock 3 weeks. If we had a debt moratorium, for example, and everything just got frozen in place and everyone's bank accounts got filled up by stimulus, could we at this point, let's say the virus cleared itself, and we essentially rewound the clock 3 weeks, in your estimation, could we get back to where we were, or is the damage just too far gone already?
Look, my gut says no. I think there's going to be lasting effects of this. And, just look at the airline industry or the cruise industry. I mean, what is it going to take to get everybody traveling the way that they used to? How many people are going to stay an extra week or an extra 2 weeks or an extra month or an extra quarter and say, you know what, I can work from here. I don't need to fly on an airplane. I don't need to stay in a hotel. That was optional. So my sense is no, but look, we're all guessing in unprecedented times.
Yeah. So yeah, the fog of war, as I like to say, Winston Churchill.
Exactly.
The fog of war. It's all a bit of misinformation. Well, lovely. Listen, Adam, it's good to have you on the line. Hopefully it soothes a few nerves to know that there are folks like you out there who can kind of parachute in and do a bit of triage or do the necessary work. So, really thank you for coming on board yet again. And who knows, maybe we'll have you on board in 4 weeks' time. And, what will we be dealing with then? I certainly have no idea. So you're a turnaround restructuring consultant for distressed businesses. Your background's in finance. You've helped a lot of struggling businesses. I know you're very much into kind of building the model, forging a course, and then, plowing on with that course. So listen, I wish you and your clients all the best. I'm not going to go through your bio. We'll just put that at the bottom of this. And so let me turn it to you. Any final comments? And this time this will be final. And thanks very much for coming on board. And, we wish you and your family safety and all the best.
No, I appreciate you having me. And I think we're all going to learn a lot in the next few weeks. We're going to be doing it together, probably with our families in very close proximity, and we'll all get through it, and everything's going to be okay.
Lovely. All right. Thank you. Appreciate you coming on board.